Joining me now, Brian Levitt, global market strategist at Invesco. Brian, great to have you back at the desk.
Thank you, great to be here.
All right, so we're looking at an S&P 500 at another record high. Does S&P it's above 6,600 make sense to you, or is this market overpriced?
I think it makes sense to me. I mean, the thing about market highs is you're going to hit a lot of market highs in your life. They happen about once every 2 weeks on average. Valuations are a bit extended, but at the same time, it's still a good economic backdrop. Inflation's, at least inflation expectations, relatively stable. Fed's going to cut. It's supportive for equity markets.
And retail sales actually came in better than expected. So even though the jobs market is cooling, the consumer is still holding up?
The consumer is still holding up, so the job market is cooling. The demand for workers is cooling, but the supply is also slowing as people are entering into retirement, as there's less immigration in the country. So the job market's slowing, but not particularly out of balance. Unemployment rate is low. Real wages are still positive growth on real wages. All that supports the consumer.
What is it, though, that's driving this market higher right now? Is it the economy?
Well, you've had a lot of, you had the concentrated move in the big tech names. That's really a bit more of a 2024 story than this one. I mean, yes, technology has done very well, but if you look at the percent of stocks above their 200-day moving average, it's not like it's 20%, right? You're well above half. So it's a broader market. You've seen financials, the big banks participate, the industrials are participating. So those sectors are usually attuned to a better economic environment. And so it's not just tech.
It sounds like U.S.-China trade deal could be coming maybe even ahead of the November deadline. Things seem to be going well on that front based on what we're hearing. What could that mean for this market? Well, seeing as we're already, 36% off the Liberation Day lows?
Yeah, this is a market that's already forgotten about trade for the most part. And so that would just be another additional positive. I don't think it's a huge catalyst to move the market significantly higher because for the most part, since Liberation Day, or really April 9th, this market has come to the view of we will get some outcome. It may not be optimal to the free trade folks, but we will get some outcome that we can live with and move beyond. So again, the way to think about tariffs is it will slow growth, the market assessed that, it will raise prices, but inflation expectations are contained. As long as businesses know the rules of the game, will be okay, and China-US would just be another big step in that direction.
So a positive but not a huge catalyst. How should we be thinking about a potential rate cut tomorrow? The Fed, of course, kicking off the two-day meeting today. The market widely expecting at least 25 basis points. How will the market react to that?
Well, it's expected. It's already been baked. The way I would look at it, people are like, why does the Fed have to ease? It's not a big easing move. You're still trying to get back to normal. Right, we're in a restrictive stance right now with the Fed funds rate well above the 2-year Treasury rate, above the 10-year rate. So you want to start to move it lower to reflect what the bond market is already telling you, which is that you've had some slowdown in the economy. So start to bring rates down to what you would consider neutral to be. Neutral could be debated, right? A lot of bright people can sit around and argue what neutral is, but it's not 425 to 450. So we'll start to lower rates to normalize the yield curve and look to reaccelerate economic activity from this period of moderating growth.
So it doesn't sound like it's a rate cut that's really going to drive this market higher, and potentially not a trade deal with China. So if not those things, what is going to push this market higher? Or where is the market going from here? I guess is the bigger question.
I think the market's going to continue to go higher. It's going to continue to be, in part, an earnings story, and earnings continue to look good. I think continue to surpass people's expectations. But I wouldn't sleep on the rate cut. The Federal Reserve is going to be lowering rates, which helps smaller businesses, which have not participated as much in this rally. So smaller mid-cap can start to participate, deeper value can start to participate. So I would view the rate cut as helping to even further broaden what we've been seeing in this cycle.
That was going to be my next question. Which areas of the market stand to benefit most from a Fed rate cut. So it sounds like this is going to be a value and small cap story. Is that in addition to a tech story?
Yeah, in addition. I wouldn't say it's either or. I mean, these big tech names are going to continue to benefit so long as we're in this healthy backdrop and we have easier policy. What it does is it starts to broaden it out and also look beyond the borders of the United States. I know people don't want to hear that, but lower rates when the ECB is no longer cutting and the Bank of Japan may have to raise rates, that narrows the rate differential, which means the dollar doesn't rally the way it had or maybe even continues to moderate. So stable to weaker dollar should start to unlock some of that value that continues to exist outside the United States.
Okay, so dig into that a little bit more. Where should people be putting money to work right now?
Yeah, I would say, I think for the most part, if investors are sitting in big tech and are sitting in money markets, right, that's been a very popular place to be. On the income side, yields are going to come down on the short end. Take advantage of the yields that are available to you.
It's a fixed income.
Yeah, well, I would say if you're looking for income, take available corporate bonds, municipal bonds. There's still nice yields that people would have begged for 6 years ago. On the equity side, look, I don't think we get rid of our big tech winners, but to the extent that we want to bring down the valuation of the portfolio and look to benefit from a reacceleration of economic activity globally, that should be small and mid cap and European stocks.
What about commodities? Because we also have gold at all-time highs.
Right.
What does that tell you about investor sentiment? And would you put money to work in gold right now?
I wouldn't put money to work in gold right now. I'm more optimistic about the economy and what the central bank can accomplish here to want to pile into gold. Gold has done very well for a long while here for a variety of reasons. One, central bank buying, and that really started when the U.S. froze Russian assets when they went into Ukraine. So the central bank buying, and then people looking for a safe haven of sorts as there's been political uncertainty in the world's largest economy, and of course that being the United States. So those two key trends. I don't think that the U.S. dollar is going away. We've seen treasuries catch quite a bid. So from my perspective, I'm not a big gold bug. If you are going to own it, 3 to 5% can often do a lot in your portfolio, but I would rather continue to own equities and credit.
Okay, so definitely still bullish. S&P is above 6,600 right now. Year end, where will it be?
Let's do quick math in my head. I think we could be close to 7,000.
All right, we'll leave it there. Brian Levitt, always a pleasure. Thanks so much.
My pleasure.
That's Brian Levitt, global market strategist at Invesco.